Hi, everyone. Dale Pinkert here at TradeGate Hub, and I'm joined by Bob Elliott. Bob got his first entree into the business. Talk about being fortunate, was under the tutelage of Ray Dalio at Bridgewater.
Yeah, that's right.
Yeah, what a great start compared to people that they get their start off Twitter, finding people. I mean, what a great start. So, you had a great start, Bob. It's great to have you here. I've talked to you once before. It was a wide-ranging discussion. I just want to ask you, when you were at Bridgewater, Ray believed in minding with his associates and analysts, didn't he? Didn't you guys have meetings and
Oh yeah, yeah, for sure, for sure. I mean, that part of the whole, part of the way to generate alpha is to bring a bunch of different perspectives to the table at any point in time, and and hash out what's likely to occur because any one person kind of sitting alone on their own is probably is not that much better than 50-50 in terms of coming up with good trade ideas. But if you can hash it out and
yeah,
work together, there's
uh,
your odds of success are considerably higher
yeah,
than sitting
yeah,
alone.
yeah, and I'm a big believer in communities nowadays because you're right. We only have two eyes. And what I really like that happens in communities, and you probably experience it still, is that when you talk to people that you respect their work and they're coming to the same conclusions using different methodologies that you're coming to, it actually adds conviction to the trade. Do you experience that still?
Oh yeah, for sure. I mean, I think it's either what you can do is it helps to triangulate from a number of different lenses. I think some people think that there's only like one way to generate alpha, and what I've found, frankly, through my career is there's lots of smart people who have figured out good ways to generate alpha that honestly are often very different from how I basically learned from a systematic macro perspective to generate alpha. And so being open to that universe of different perspectives, I think, is really important. And then at the same time, I think it also is useful when they disagree with you to help challenge your thinking about things, to say, have you really thought about everything on your mind? And I think that that's super valuable. I find it. I have we definitely existed at Bridgewater in many ways, but I've been pleasantly surprised, through Twitter and other and places like that in the outside world, so to speak, at just how good the quality of conversation is and the perspectives. I mean, basically as good as any person sitting at some of the biggest institutions in the world. So that's pretty
It,
exciting.
it is done virtually, and you bring up a great point. And the reason people don't think about it is because it doesn't show up on your P&L if you avoid making a trading mistake.
Oh, that's so true.
So people think, well, um, they don't take that into account, that you can avoid drawdowns by, I say, keep an open mind. It'll keep your account open.
I like that. That's spot
All right.
on.
So anyway, I know because I've had a few close on me. So we learned the hard way, Bob.
Haven't we all, right?
Yeah. So I went through I'm showing your unlimitedfunds.com site, and I went through a few things, and I want to talk a little bit about gold, because there are people that believe in gold, especially if they're in the physical industry. Don't wait to buy gold and wait.
Mm,
Right?
yep.
But you think that gold adds a certain amount of favorable, positive attributes to a portfolio that some people, recognize it could be a hedge against a dollar. It could be a hedge against maybe a credit crisis, but we've also seen gold suffer when there's a liquidity crisis. So tell us what qualities gold adds to a portfolio that you like. And I think the comment on Twitter was, you laughed when you said that, gold is good for a portfolio because you're not exactly Mr. Goldbug.
Right.
right?
Well,
All right.
it seems like anytime I bring up gold, people's eyes glaze over and they think, like they look at me like I'm a crazy person.
Yeah.
I'm about as straight and narrow as they come. And so, I look at gold as a financial asset. When you think about it as a financial asset, what is gold? Gold is non-interest bearing money that can't be uh, inflated away by a central bank. And so, if you think about that and the context of that, you have a situation with gold where let's call it the chop looks a lot like the trade between interest bearing money and non-interest bearing money, which is when interest rates rise, typically gold
Right.
underperforms, and when interest rates fall, typically gold outperforms. But that chop can obfuscate longer term trends, which I think, if I look in the last, over several time
So,
frames, say since the beginning of 2022, or even over the last 5 years, what you see is that gold also provides a critical protection against tail risk events. And so, and the
because it
reason why,
was down less, Bob. I mean, that the bulls were pointing to before this recent run that we had from 1600, that although gold was down, it was not down as much. So in
well,
comparison to other assets,
yeah, I
is
mean,
that
like
an edge?
look
Okay.
at last year, right?
Yeah.
Last year, gold in dollars was flat essentially,
Right.
right? When bonds in dollars were down, long
r-
dated bonds, because gold is a long, very, very long duration asset. It's an infinite duration asset, right? Because it doesn't
Right.
deteriorate. And so, very, very long duration bonds were down, let's call it 20 or 30%. Real long duration tips were down 20 or 30%. Financial assets in aggregate were down 20%. And so gold in that context did very, very well on a relative basis in dollars. And I think people often forget that there's a range of different plausible outcomes. It happened that the Fed last year was the tightest central bank in the world responding to what was going on. So gold was flat in dollars, but in all other currencies, Australian dollars,
Yeah.
Canadian dollars, sterling, euros, yen, gold had a great year. And that was a time when those countries' stock markets and bond markets were both down. And so when you think about the distribution of plausible outcomes with gold, what you see here is that gold is a diversifying asset. And in fact, gold outperforms bonds. If you look over the last 100 years, gold outperforms bonds in 50% of stock drawdown environments. Okay, so what does that mean? Just in the same way we've all learned, basically, bonds are a good hedge to stocks. Why not gold as a good hedge to stocks when
Yes.
stocks go down? And again, in a strategic portfolio, because 50% of the time, gold is a better hedge than bonds. And it's just because we've lived through this whole environment. We've lived through most of us, uh, all we know is disinflation until the last
Right.
year or two, right? And
This is a new
so,
paradigm, and the whole world is suffering from recency bias, isn't
right,
it?
right, totally. And it's both it's a new paradigm to us. That's what I like to say. This cycle and this inflationary dynamic is totally new to us in our life experience,
Yeah.
but totally normal to someone who's looked at financial markets over the course of the last 150 years. This is a totally normal phenomenon. So rather than be shocked by it, go look at those previous instances. There's always slight differences this way or that way in any cycle relative to past cycles.
Yeah,
But
they rhyme. They
but they
don't
rhyme,
repeat,
yeah.
they
But the
rhyme.
big
Yeah.
picture, and in particular, like the way financial assets work, financial assets that have been around for 100 years, like it's not ambiguous about how they respond to macroeconomic dynamics, right? Go look at how they respond to macroeconomic dynamics, and what you'll see is you'll understand how gold can be a diversifying asset through these sorts of periods.
Okay, so adding it to a portfolio, are you price sensitive then? You look for tactical entries in the gold market?
Well, I think I mean, of course, you're probably more tactical than I am when it comes to gold. And so, I mean, to be honest with you, I've had between 10 and 15% of my personal strategic portfolio in gold, and I just rebalance a little bit, whenever
Okay.
it gets a little bit out of it. Probably lazier than I should
Oh,
be on that, but
okay.
there you go. I got other things
Anyway, I
going.
mean, this was a very nice run that we had in gold from 1610 to the recent high up here, Bob. I'm viewing this as, a nice pullback to
Yeah,
add on. Do you
I
do
think it
you
is. I think
do
it is a
you
nice pullback to add on.
do you look at miners the same way? They're not as good of a hedge
Yeah,
because they're more stock sensitive, right?
yeah, and miners like what gold. You're making a bet on the metal,
Right.
and its properties, which are pretty constant through time. The problem with the miners is you get all sorts of different things you got to worry about. Like you're making a
Yeah.
bet on cost, on the cost
Right.
structure of those.
Yeah, you have to bet on the jockey
right.
when you look at miners. You got people that have a good track record, having successfully started a mine and built it up, and went through all the trials and tribulations of development.
For sure, and
Right.
we know there that there's lots of exogenous forces like energy costs. Obviously, to get gold out of the ground, a big part of it is energy costs. You're making essentially a short energy bet on
Yeah.
betting on the miners. That may be a bet you like. That may not be a bet you
Yeah.
like. But there's a
You
lot.
also have geographical risk, right? I mean, I'm
For
looking
sure.
at a miner, and what's holding me back. I like it, but it's the mines are in Nicaragua.
Yeah, and
Okay,
to be
so
honest with you,
go
I'm
ahead.
too ignorant of all of those underlying
Yeah.
dynamics to be able to have a good conversation. Certainly on any particular miner, which is why I like to simplify the world to the
Yeah.
to the few things
Well,
I know.
I do it by talking to others that know, because I
Yep,
mean, time is our most precious commodity, right?
for sure.
And so, I mean, if smart people that do all the due diligence on the issues, and bring it to you like the way you provide information for people on your site, encapsulate it for them and help them understand it. That's what I do, because you don't have time to do everything. And I want to also move up to, we have the Fed coming up in March. I saw on your Twitter stream, Bob, that you think the market's not even really considering it at this point, that the Fed could go 50 at the next meeting.
Yeah, that's right. I mean, I posted this, I guess, about 10 days ago, give or take, around the pricing, which was, I think it was only priced something like 8 or 9% for the possibility of any 50s over the course of the next 3 meetings, and basically said, look, that seems like a pretty low pricing relative to the possibilities. And that has moved. Well, I think the March Fed funds have moved from pricing in something like 8 or 9% to pricing in 25% probability of a 50. It's like every day we get an incremental new piece of information which should push the Fed in a certain direction. And I think some people are concerned that the Fed might not want to go back on their, they moved 25 to go
Yeah.
back on that and go to 50. But I think the most important thing that we've seen from this Fed, which is kind of interesting, is that actually the market in many ways dictates what they're probably going to do. If the data comes,
does the Fed follow the bond market?
I mean,
It doesn't lead it, that's for sure.
yeah, I think in a very tactical way, when it comes to individual meetings, like it used to be, and I'm sure, Dale, you remember this, there used to be ambiguity about what the Fed would do
Oh,
at any given meeting.
we
Right.
had to kind of figure out what Alan had in his briefcase,
Right.
if it was heavy or light or
right. I remember that. I remember
Yeah.
that. That was in my
The suitcase indicator.
nascent days of trading markets. That's exactly
He
right.
was the best at saying things and people going, pretending they understood what he said.
Exactly.
He was the best, the maestro.
I think that they've changed, starting with Bernanke, but really kind of being codified here in the last decade. The Fed almost always is going to position or change rates consistent with whatever's priced in, essentially the day or the week before the actual meeting, which is interesting because it means actually that the markets could move this pretty well, in the sense of, if the markets figure out or recognize that there's enough good, strong data, they've already moved it from, below 10 to 25. I could easily see, the combination of today's GDP deflator data plus, we've got plus based on initial claims, it looks like we're going to have a pretty strong February jobs report, or it's going to be, probably going to have a pretty strong February jobs report, or should have a strong one. And so you put that all together, we get another hot CPI print. There's a lot of options here to point to move the market towards 50 in March, and overall just kind of move the market higher on even the terminal rate. I think that's the thing that we're broadly wrestling with right now, is like, where is that terminal rate? And the thing I would emphasize is we don't know, the Fed doesn't know, and anyone who tells you that they know with any certainty is either lying to themselves or speaking in a way that's overconfident.
Okay, well, I never say for sure I know, but I can say that this move from the last NFP, where we had a breakout here over this 357, which measured 380, and we have also broken out of a downtrend. Right here, right? But some of my work is saying that this part of the move could be over, and we could have a nice little drop in yields, maybe even back to where this move began. Can you think of any kind of catalysts that could, now that everyone's bared up about yields, or bulled up about yields going higher, that they could be offsides again, and we could get maybe a half a point pullback in the 10-year?
Well, I think I think there's probably two things that would cause that. I think if we were to see some weaker, inflation or growth data, whether sort of, let's call it real or imagined, real or just reported. And I think this question of 50, like you've got, it's interesting. Like there's a bit of a bimodal set of thinking here over the course of the next couple of meetings about whether the Fed's going to really go all in on frankly running the policy I think they should run, which is tighter monetary, tighter, but they could easily come out and signal that, they're going to take their time and, maybe raise 25 a couple of times, but kind of let the thing settle through. I think those are two things that could tilt the bond market for a rally. So that's what I'd be looking out for on that.
Okay, you think that would light up equities again after this pullback we've had?
Probably
if yields
would.
dropped a half a point.
And, for sure. I mean, that's the thing, that when you think about this overall market environment, like what you see is that everything's trading on the Fed. Everything's still trading on the Fed, right? Assets in general. And so, I think that's just important to recognize. It's important to recognize when you're building a portfolio that because everything's trading on the Fed, like your correlations are going to be, as close to -1 as they ever are, which is important to recognize. And so, given that, you want to be careful in your risk management, that you're not just finding yourself in an odd space. I don't know what's going on with this Zoom.
Let me ask you this. I think, we'll probably be getting to the meat in this, where you're saying that major asset prices, although they're down, that they're still pricing in improbable outcomes. Okay, so what do you mean by that?
Well, I think the main thing that is going on in terms of the outcomes, when you look at, I think the most improbable outcomes are in the equity markets, and particularly in the high beta equity markets. And so what you're seeing, what's being priced there
is a no landing. We've gone from soft to a no landing now.
Is really a no landing scenario where, if you think about it, it's hard to believe, but stocks are more expensive today than they were in January of 2022. And the reason why that is that the combination of the decline in the decline in long bonds, or the rise in rates on the long end, combined with the rise in the dollar, since that point should have put a pretty sizable dent into the equity market. Let's just say on S&P 500, 20, 25%, right? Stocks should be down just based on that account. And this most recent bond market sell-off is just adding to that pressure. Yet, stocks in general are not down that much, all things considered, which reflects the fact that the earnings that are priced in to most stocks, the earnings that's priced in, remains pretty elevated. All things considered, the stocks are just discounted earnings into the future, just to get overly simple about it. And so the discount rate's gone up a lot. And but people's earnings expectations have gone up even more than that. And so you add that together and you say, stocks at these levels do look overvalued and pricing in a pretty low probability, essentially no probability of a recession, or any real drawdown in anything.
And you also say positioning for the market still positioned, not just opinions, for implausible outcomes are not priced in, or are priced in, implausible, and that's a no landing.
That's right.
Okay.
And in particular, if you look out, we started to see, it's amazing how much things have changed, at least in the bond side of thing over the last couple of weeks. There was a time when 50 basis points of cuts were priced into the back half of 23, right? And that you look at that and you say, no way. Like that was a very low probability. All of that has unwound. The thing that's very interesting is 150 basis points of cuts are priced into 24. Like those December 24s versus December 23s is, 150 basis points of cuts in a 1-year time frame is about as fast as the Fed would do, except for extraordinary crisis outcomes.
All right, an extraordinary crisis, and I talk to smart guys like you a lot, and I talked to someone recently that his concern comes out of the shadow banking system.
Yep.
That back in 2007, it was about, the size of it was about half of the open commercial banking system that we have, and it's grown to 1.5 times as large as the commercial banks. And you're talking about Blackstone and
right.
The big players there. He thinks a credit event comes from having problems financing, that these companies are going to have some problems, and there's going to be a credit event that comes from that. Have you thought about that? Is that something that you've considered, that the shadow banking system could be ground zero this time?
Yeah, I think
it was last time too, wasn't it?
Yeah, I mean, there were certainly many shadow banking type dynamics that caused the core of the problems the last time. I think the thing that, for context, 15 years ago, my job was figuring out whether or not the financial crisis was going to be a big deal or not. And I spent a fair amount of time working with the Fed and the Treasury to help them understand the risks that existed there. I think the main thing that, I'm going to shift these cameras because I don't know why this thing is being silly, but here you get a slightly worse view of me.
No, we get to see your spaceship. All the screens, we get to see the control panel. So
exactly.
All right. So do you think it's different this time?
Well, so I think the thing that's mainly different this time is that we're in a situation where, where a lot of the lending back in the financial crisis was really driven meaningfully by levered institutions. And I think the thing that what you see in this more recent period is that there's been the lenders are unlevered. I think actually like the BREIT thing is a good example. It's levered to, it has a little bit of leverage in it, right? Most of the buyers of that product are pension funds, endowments, and other unlevered entities. And so what's happening here is that like BREIT is seizing up. There's no question about that. People aren't able to get their money, by the way, what a great example. Like if you're in a product where they say it has a marked price, but you can't get your money out, it's a lie. That is not the value of the asset, right? They're just lying to you about the value of the asset. And so, but what are the consequences of it? The consequences are, even if BREIT takes losses, the odds that they're going to see a situation that is really meaningfully a meaningfully bad outcome isn't that high, because they've got a lot of equity in that business before it's going to be a problem. And then on top of it, the risk that you're going to have an event that causes the original end lender to have a crisis is also pretty low, because you're a pension fund. Like, what's the impact? The impact from a pension fund's perspective is they just lose money, and that like kind of sucks. And their pensioners have to pay out more over the course of the next 20 or 30 years. But no one is getting squeezed.
Pay out less, or they
pay out less, and it hurts incomes. But that's a 30-year story, so no one's getting squeezed in that dynamic, right? That's the basic issue: is who gets squeezed. And I think the answer to that question is, at least right now, I don't see a scenario where people are getting squeezed meaningfully as a function of those credit losses. And that's radically different than what we saw in the financial crisis experience.
There are some big players walking away from Class A buildings that they've owned. There are some problems with people walking away from things.
Yeah, for sure. And we're going to have distressed assets, and those assets, I mean, for those of us who lived through the financial crisis, we know how this works, which is that people walk away, they put the keys in the mailbox, so to speak.
Yeah.
Right. And then the distressed guys come in and they scoop it up at 60 cents on the dollar, and, at better yields, and slowly but surely other things get repriced as a function of that. And so when we finish, and we'll work through that, and that'll take 5 years, and that'll be okay.
All right, Bob, I'd like to wrap it with talking about your ETF that you designed here.
Yeah, for sure.
And how much is it's a fairly new one, and it's designed after hedge funds. So you are executing hedge fund strategies that you know of, or hedge funds are doing it within your ETF?
Yeah. What we do is my partner Bruce and I have about 50 years of experience building proprietary hedge fund strategies across all the major fund styles. And so what we've done is we've developed a technology that allows us to look at fund returns, and from fund returns be able to back out basically what positions are driving those fund returns using machine learning, and frankly machine learning paired with our decades of experience running this money. There's a good set of photos of all of us. I like it. And so from that, what we do is we take that understanding and we translate that into long and short positions that serve across the major 50 or 60 liquid markets, and those positions serve as the backing of our ETF. Our goal is to replicate the gross of fees returns of the hedge fund industry. And instead of charging 2 and 20 for it, we charge 95 basis points of management fee. So it's basically, and it's an ETF wrapper. So if you're a taxable investor, that's much more tax efficient than traditional LP positions. So the basic idea is diversified, low cost index returns for the hedge fund industry, at a quarter of the fees and half the taxes. So that's what we do.
Okay, and that's where you could find out about it. Want some information, go to send Bob an email, info@unlimitedfunds.com. Really great conversation again, Bob.
Thank you so much.
Whether you were a ghost or whether you were
I don't know what's going on. Zoom updated on me, and look what happened. I feel like things so darn buggy these days.
Really appreciate you edifying the community and sharing your wisdom with us today, and look forward to conversations down the road.
Thanks so much for having me, Dale. And for folks who want to check it out, check me out on Twitter, Bobby Unlimited. I'm there. I do a lot.
All right, everyone. My trading warrior brother, Bob E Unlimited get that at Bob E Unlimited on Twitter. Follow Bob, and you're going to learn some things you didn't know before you followed him. Perfect. I guarantee that.
Thank you so much.